Hi, everyone. I hope everybody's doing well. Just waiting for a few more people to log on, and Tara, our 1031 exchange coordinator, is having some technical difficulties, but we will get through this. So Tara, I think she may be joining us. Now, while she joins, I'm going to go ahead and introduce myself, share a little bit about what we're going to be talking about today, and then get straight into it and hand it over to Tira, and I'll be coordinating the presentation for her as well. So there she is, and Tracy too. Thank you for being here. So my name's Stephanie, and I'm here with True Door Property Management. I'm a portfolio sales manager here with True Door Property Management. And we're kicking off the first webinar. We're very excited to have everybody on board. I think this is a great topic for a lot of our current investors, also future investors. 1031 exchange is a very hot topic, and it's a great investment strategy. So we're going to share the process today and share with you guys a bit about how it works. So we have Tara Walker, who is a 1031 exchange coordinator, along with Tracy King. And Tracy is also an escrow officer. So she'll talk about the importance of a 1031 exchange coordinator and an escrow company and how they both should be in sync and be working together. So I really want to thank them for their time. Thank you, Tira and Tracy. We also have Kyle and Bryant, who are the owners of True Door Property Management, and they're here with us today. So we're going to be having different topics of discussion, guys. Every single month, we will make it our goal to have a webinar for, like I said, our current investors or future investors. And that's a little bit about me and a little bit about the company. So we're going to hand it over to Tara Walker. Tara, are you there? If you can unmute your mic, there you go.
Yeah, can you hear me?
Yes.
Okay, great. Hi, everyone. Thank you so much. It's a pleasure to meet you all. Are you able to see me on the screen as well?
No, if you
Okay.
click your camera, it should turn on your camera on your phone.
Yeah, I've been trying to play around with it, but I can't seem to get, I think, is this working now?
No.
Okay.
That's okay.
Right.
We'll
Okay.
figure out your camera situation later. What I can do is
Okay.
I'll start sharing my screen. I know you were having issues with your computer. So can everyone see my screen? I'm gonna go ahead and close out these tabs. Can you guys see my screen? Yeah. Okay, awesome. Tara, can you see my screen?
I can. Yes, that's
Okay,
perfect.
So I will move it along as you tell me, and we'll get started whenever
Okay,
you're
that's great. So just for your own reference, my contact information is on this first page. So if you do have any further questions after the presentation, you're more than welcome to reach out. On the next page, it goes over our agenda. We're going to just do 4 major topics: qualifying for an exchange, the vesting and title, and then what a like-kind exchange is, and then the exchange timeline. And then we're going to leave it to Q&A, where we can get into the more nitty-gritty with experiences that you may have had or questions you've had through experiences. So let's get to the next slide, number 1, qualifying for an exchange. So this is kind of the pre-qualification, if you will, to make sure that the sale property will qualify for a 1031 exchange. And what we're looking for is, on the sale property, we look to see who has been placed on title for the sale property. We find that in the preliminary title report. And we need to make sure that that person who is on title has owned and claimed the sale property for a minimum of 2 years as a non-primary residence on their tax returns. If they've done it less than 2 years, if they've just recently purchased this and they've just recently wanting to put it on the market for a 1031 exchange, the IRS looks at that as a flipped property and they will disqualify it as a 1031 exchange. So it is very important to make sure that before selling it in a 1031, you've claimed it on your taxes as a non-primary residence for at least 2 years before selling it and engaging it in a 1031 exchange. Now, the purchase property, that will be treated the same once purchased. You'll need to retain that for a minimum of 2 years and filed it as a non-primary residence on your tax returns during those 2 years. So the way I like to look at it is like bookends, which is why there's a little picture of bookends on that. So that the sale property, you've owned it for 2 years before selling it, and then your purchase property, you need to own that for 2 years before exchanging it again. Otherwise, IRS sees it as a flip property and will disqualify it. So that's the big item for qualifying the property for an exchange. How long you've owned it, how you've claimed it, and who is on title. And I'm sure we're going to have some questions about title changes, and we can hit that in our Q&A. So if you do have any questions about title changes, just put a little notation down and we'll get to that during Q&A. In our next slide, we have vesting and title. So because the 1031 exchange is a tax deferral program, it's important to understand how this exchange is registered in the tax returns. And it's registered as a 1031 exchange under the tax ID number that is associated to the name on title at the time of the sale. And that's important because if you have your title in something other than what you want to purchase under, you've got to seek tax advisor, tax attorney advice on that, because that tax ID number that you're going to use on the sale property needs to continue through your exchange onto the purchase property. And that tax ID number is associated to the title on the preliminary title report. So if the title on the preliminary report says Joseph LLC and the tax ID number is its own separate tax ID number for Joseph LLC, then when you go to purchase, you need to be purchasing under Joseph LLC if it has its own tax ID number. Some LLCs share the person's social security number. So maybe you're selling it under Joseph LLC, but you're going to be taking title under Joseph Lark, and you don't want it a part of the LLC. If the social security number tied to the sale on Joseph LLC is the social security number of Joseph Lark, then it will be fine to purchase under Joseph's name, just as long as that tax ID number is his social security number that was associated to the LLC. So again, always reminding ourselves that 1031 exchange is a tax deferral program, so it's tied to a tax ID number and the person associated with that tax ID number, and it's the sales that sets the tone. So best practice, your vesting or title should remain the same throughout the exchange. Well, what if my sale property was under my exchange before I got married, and now I'm married and we're going to be purchasing the new investment property under both of our names? Well, do you file taxes jointly? And if the answer is yes, then no problem at all. You can add your wife's name to the title for that purchase property or your husband's name for that purchase property, as long as you're filing taxes jointly. Won't be a problem. Well, what if I have a partnership and my partners don't want to enter a 1031 exchange, but I do? All right, well, here's what you've got to do. You've got to get your name deeded out of the partnership and onto title as just your name. And we're going to need to know the percentage of your ownership. This is a time where you've got to seek counsel from your tax advisor or your tax attorney or your CPA. That person is the one who's really going to need to okay you for deeding the property into your name or into your next LLC before closing escrow on the sale property. Here's why. If we go back to that previous idea on the slide about bookends and your title shouldn't change 2 years before selling it, if you're changing your vesting out of a partnership right before escrow closes, that might cause a red flag for the IRS. And that's why you've got to seek advice from your tax advisor who's going to be filing your taxes for you. So again, best practice, you keep the name or the title the same throughout your exchange from the sale into the purchase, and keep it the same for 2 years after purchasing before you do anything to it. If you're going to do anything prior to that, seek tax counsel for sure. Into the next slide. Like-kind exchanges. I like this. A lot of people, is my print not showing up on that slide? Is that blank? Okay. Well, grab your pen and paper or grab a pen because I'm going to have you actively engage in this slide, number 3. I'm going to have you take some notes on this slide. And if you don't have the slide printed, just grab a piece of paper and then transfer your notes onto this slide when you print it, because this is important. A lot of times people call me up and ask about a like-kind exchange, and they think that a like-kind exchange means the type of property, house, commercial building, land. Like-kind does not refer to the type of property. Instead, a like-kind exchange refers to the price. The price is what is important here. If you're going to do a like-kind exchange, what you want to do is whatever your total consideration sale price is, you want to make sure that your purchase price, total consideration, is the same or greater than what you sold for. So I'm going to say that again. Whatever your total consideration sale price was before commission, before closing costs, that is the price that you want to match like-kind to for your purchase. So if you sold for $1 million before commission, before closing costs, you want to make sure you're purchasing at $1 million at minimum. That is the only way you are going to guarantee that you have 100% tax deferred exchange, is if you're matching your purchase price to your sale price. And that is a like-kind exchange. You can sell a rental residence and buy a commercial 7-Eleven property. You can buy land and buy 2 duplexes. You can sell 7-Eleven and go for a single family residence. Totally fine. What matters is the price. You've got to match the purchase price to your sale price. Total consideration. That's number 1 about a like-kind exchange. The second thing that a like-kind exchange refers to is investment property for investment property. You cannot sell a primary residence and use that money as a tax-deferred exchange for an investment property. You have to sell an investment property and buy another investment property. So it's only investment property for investment property. So that's the second note on a like kind exchange. Okay, so those are the two notes so far. Purchase the same or greater than the total consideration sale price, and you're selling an investment property to purchase your next investment property. Now, here's the third thing I want you to take a note on for this slide. You see that picture of all the boots lined up? In a 1031 exchange, they talk about boot. And usually what everyone hears about is a cash boot. Oh, you don't want to be stuck with a cash boot. You're going to get taxed on it. And they're right. A cash boot is when you don't reinvest your sales funds back into your investment property, your next investment. So if you sell for $1 million and you're only going to spend $500,000 on your next investment property, you're going to have a taxable $500,000 boot, because half of that $1 million from the sale did not get reinvested into the purchase, your next investment property. So the way to avoid a cash boot is to make sure that all cash sent into your exchange account is reused and spent on your next investment property. The other pair of boots, there's a pair of boots here. There's the cash boot, and then there's a mortgage boot. Most people don't know about the mortgage boot, and they get stymied in the end with having to owe taxes. And that happens when they have a mortgage or a loan on their sale property, and it gets paid off, right? And that's your debt getting paid off. Sure, you don't pocket the cash, but it did go to pay off your debt on that sale property. Well, you need to reinvest that loan amount or that mortgage amount. If you don't reinvest that mortgage amount, you're going to be stuck with the second pair of boots. So if you think of this as a pair of boots, you want to avoid the boots. You want to avoid the cash boot. You want to avoid the mortgage boot. And the only way to avoid those boots is to reinvest that amount back into your purchase property. So if you sell for $1 million and you had a $500,000 loan on it, when you go to purchase, you need to make sure that you reinvest that $500,000 loan payoff. You've got to get that back into your next purchase. You can do that in 3 ways. Number 1, take out a loan for the same amount, $500,000. Or number 2, supplement it with all cash if you're cash rich, $500,000 back into the next investment property. Or do a combination of the two. Lower your loan, but supplement the rest with cash. So do a loan of $250,000, supplement it with $250,000 cash. As long as you're reinvesting that loan payoff back into your next investment, you can't get taxed on that mortgage boot. Okay, so you want to avoid the pair of boots. That's the third note. You want to avoid pair of boots. And there's 2 types, the cash boot and the mortgage boot. And you just want to make sure you're reinvesting that back into your next investment property. Okay, next slide. All right, here's the timeline. So everything I've been talking about and what Safe Harbor Exchange does, we do forward exchanges. They're the most basic exchange, they're the least expensive exchange, and they're the easiest exchange to complete. The forward exchange is when you sell your sale property first, and then your funds come into an exchange company, and then you close escrow on your purchase property. So the forward exchange, your sale property must close first, and then your purchase property can close. There are other types of exchanges. There is a reverse exchange. We don't handle those. Extremely expensive, very timely. cost prohibitive most of the times for our exchangers. A reverse exchange happens when your purchased property closes escrow first, and then your sale property closes escrow. We don't handle those at Safe Harbor. They're very difficult to work with an exchange. So if that is something you're going to do, a reverse exchange, let me know. I can refer you out to someone. The forward exchange is the sale first, purchase next. The IRS gives you exactly 180 days to complete any and all purchasing. If the 180th day, by the way, the timeline starts the day you close escrow. So if you see on that slide, sale property closes, boom, that starts the time ticking. And the 180th day is the deadline. Now, the IRS unfortunately says that if there is a holiday, like we just had the Memorial Day weekend, or a weekend, then you must close your exchange. You must finish your purchase before the holiday or before the weekend. So if anybody was coming up on their 180th day yesterday, we would have wanted to close escrow on Friday before it. So the 180-day deadline, that's what they give you to close on all of your purchases. There is one other important deadline that occurs on that 180-day timeline, and it happens on the 45th day of the exchange. On that 45th day or before, the exchanger needs to identify in writing the property address or addresses that they intend to purchase. Every company has a form for this, and every company's form is different. You just need to make sure that whatever company uses for their form, you have completed it correctly. And here's typically what those forms require. 3 things. A property address that's going to be purchased eventually, no later than the 180th day. The exchanger's signature, and the date in which abides by the 45-day timeline. So it's important to make sure that the exchanger dates the form correctly. The exchanger never wants to put a date on this form that is after the 45th day of their exchange. So it's very important that exchangers are very aware of what their 45-day timeline is, that deadline, and they make sure that they write a date on that form that is a date that falls on or before the 45th day of their exchange. Now, at Safe Harbor, you can turn that form in to me anytime you want. I'm going to check it, though. I'm going to make sure that you have written an appropriate date on that form. I'm going to make sure that you've signed the form, and I'm going to make sure that there is a property address on that form. And before I ever close out a file, I always go back and check that form to make sure that the properties that we have closed escrow on are on that form. It's a very important form. And again, whenever you get me the form, that's great. 45th day, 50th day, 60th day. But if you've written a date on that form that is past your 45th day, I'm going to kick the form back and have you rewrite a date that falls on or before the 45th day of your exchange. Okay, there is one question that comes up with this 180-day timeline. What if I need to extend it? Great question. Here are the only times I've seen the IRS allow for an extension. If you've been hospitalized. And for example, we had a client who actually contracted COVID and was hospitalized for 2 months. And with the doctor's letter, we were able to extend the extension 180 days based on that letter, kept it in the file. And when he filed it with the tax attorney, with his CPA, everything went smoothly, no problem at all. So It'd have to be a pretty traumatic event with a doctor's letter. The other way for an extension is something that California and several of our counties have experienced. It's when there is a natural disaster. And what we just experienced in California, several of our counties with the flooding, which many of you I'm sure are aware, we had the extension of the tax deadline to October 16th. That extension was granted to 1031 exchanges also. So anyone living in those approved counties for a tax extension also received an extension for their 1031 exchange. So natural disaster and severe medical condition accompanied by a doctor's letter. That's pretty much the only way you're going to get your 180th day deadline extended. Okay, next slide, Q&A. I am ready for all the questions.
Awesome. Well, thank you so much, Tara. That was a lot of information, and you really helped me simplify this. So I think hopefully we have some questions. If anybody has any questions and wants to throw them in the chat or raise their hand, Brian, I think you have some. I got a few lined up after you, but if you want to go ahead and ask your question now, would be.
Yeah, I was wondering, you had said that as long as the form says the date before, even if it comes to you after, so is that kind of a loose date that as long as the form is correct, that you could potentially find a property after?
Well, let me put it to you this way.
Yeah.
And again, every exchange company is different. When a client becomes audited, right? If a client gets audited on their tax returns, including their exchange, the tax advisor on behalf of the IRS asks for certain items from the exchange account. One of the items that has to come from the exchange account is this formal form where people designate their property, okay? Our company, we call it the designation form. Other companies have different names for it. So we have to we email with other forms that we have in our file, the exchange agreement, the contract, the final summary report. We have to send all those over to the client and CPA if there's an audit. So if an auditor is looking at the forms, the auditor is going to see our designation form and is going to see a signature on the form, a property address on the form, and a date on the form. The auditor will look to confirm that the signer is the exchanger, that the property written on the form is indeed the property that was purchased, and that the date written on the form is a date that falls on or before the 45th day of the exchange. They do not subpoena our emails that shows when we receive things. And quite frankly, when I receive these designation notices, I usually get them via snail mail or fax or email. But again, I immediately take the form, put it into the file after checking to make sure that the date is appropriate, the signature is appropriate, and the property is appropriate. If I ever am closing an exchange and I find a designation notice that doesn't meet our requirements, I kick it back to the exchanger and have them complete it correctly. But I will tell you, I'm never going to accept a form that's not completed correctly. So I'm not giving you an exact answer as to this form, but I am giving you the roundabout answer where what matters is what's on the form, not when I personally receive the form.
Okay.
Yeah, thank you.
All right. Awesome. Thank you, Tara. Thank you, Bryant. We do have a few other questions. Veronica, who is one of our clients, would like a few more examples and illustrations if possible, maybe examples on the cash boot and mortgage boot. I think you jumped in,
Mhm.
Veronica, as she was talking about that. So if you want to just kind of recap what that actually means and maybe give an example about that.
Sure. So the whole goal of a 1031 exchange is to defer 100% of the taxes, usually. Rarely do I come across an exchanger who wants some cash out at the sale. I want to talk more about what happens once the sale is completed and the funds are in the exchange account. So let's not talk as if someone wants some money out at the time of sale, because if that happens, escrow prepares a 593 tax form for a sale in California. They'll do the withholding and they'll send that cash minus the withholding on to the seller. The other funds that come into the exchange account, that's the cash we need to make sure that we spend it all on a purchase property, because that is the cash that has come into the exchange untaxed. And if you don't use all of your cash that's in your exchange account, then at the very end, when we're getting ready to close your exchange, that leftover cash that didn't get reinvested now becomes taxable. So that cash that's left in the exchange will have 3 1/3% taken from it and sent to the California Franchise Tax Board as the withholding. And then the rest of the remaining cash goes to the exchanger. Best practice, though, is to avoid the cash boot altogether. Best practice is to get all that cash from your sale, all of it, into your next investment property. That's how you avoid that cash boot. And if you think as boots as a pair, you've got to have 2 pair of boots. The other boot that you could be taxed on is a mortgage boot. And this is when you have a sale property that has a mortgage or a loan on it, and it's going to get paid off at the time of sale. That payoff amount needs to get reinvested back into the next investment property. If it doesn't, it becomes taxable by 3 1/3 for state. So if you sell a property for $1 million and you have a $500,000 loan or mortgage that gets paid off on that sale property, then the rest of the cash is going to come into the exchange and sit. When you're ready to purchase, you need to be looking for a purchase property that's going to be $1 million or more. And you're going to need to reinvest that $500,000 loan payoff back into this next purchase property. You can do that by taking out another loan of $500,000. Or you could take out a loan or mortgage that's maybe $250,000, but now you've got to supplement and bring in additional cash, $250,000 cash, to get you back up to that mortgage payoff balance. So really, ideally, if you have a mortgage payoff, you should be thinking on your next investment property of carrying that loan into your next investment property. Of course, you'll need a new loan officer, et cetera. But if you've got a $500,000 mortgage that gets paid off on your sale investment, you better be thinking about getting that $500,000 loan back into your next investment. If not, whatever the difference is becomes taxable. So if you want to carry a lower loan and not supplement it with cash, maybe only $250,000, then you're going to look to pay taxes on that $250,000 remaining mortgage that doesn't get reinvested back into that property.
Thank you, Tara. I hope that
Yeah.
answered your question, Veronica. If you have more questions, definitely reach out to Tara. Her contact information is right here. Sorry, go ahead.
Stephanie, real quick, and it's always a good practice, just generally if you're trying to invest, to leverage your money in a greater way for the next purchase, so that you're controlling a larger asset, so that your gains are going to be larger as it appreciates and grows. So generally that should be the case. So when people are exchanging, if you're downsizing your loan, that means you're typically going to be downsizing your property. And that's usually not a great strategy if you're trying to grow.
Yeah. Yeah. The idea is to, each time you relinquish an investment property, go up in your next investment and just keep going up. I have a client who started years ago with a small rental property, and now they are exchanging motels and hotels.
Yeah, I think that's a great point, Brian and Tara. Going back to the like kind exchange, right, of equal or greater value. The whole point is to defer those taxes or capital gains onto a bigger like kind or bigger property or bigger investment. So awesome. We have one other question. I got two more, and I want to give Tracy at least 5 or 10 minutes as we get closer to finishing this call at 1 o'clock to kind of go over the escrow process, because I know a lot of you are having to sell, right? You have to sell your property, go into escrow, and then the 1031 exchange coordinator will help you with the 1031 exchange process. So we'll kind of cover that. But we have one more question. Felipe asked, what if I identify a property and then the purchase doesn't complete escrow, meaning they don't close escrow, and another property is identified?
So IRS would say if you're past your 45th day, that's it. That's what the IRS would say.
Got it. Okay.
But we're recording this call, so I can't say what I say. But if you refer back to what I answered previously on that 45-day, on that form is really critical. And I just don't question my exchangers if I get a new form, a revised form after the 45th day. I just don't question my exchangers. I replace it, no problem. My goal is to get these people not having to pay taxes on their investment properties, especially since they're well-intentioned in purchasing the next investment property, and they're doing it within 180 days.
Right. Yeah, great points. And so it is a very time-sensitive matter. If you guys need help with any of this, make sure you guys reach out to myself and Tara, and we'll hopefully streamline the process for you guys. One last question, Tara. We have a lot of landlords that live out of state. One popular question that came about is, can you do a 1031 exchange from one state to another? Let's say I want to sell my investment here in California and buy another one in Arizona, and also do a 1031 exchange. Is that a possibility?
Not only a possibility, but that is the trend. Yep, absolutely. Anywhere in the nation, including the Virgin Isles.
Yeah, I've been getting that question asked a lot. So I can see why it's become a thing, especially.
Yeah. A lot of investors are leaving their investments, moving their investments out of California, unfortunately.
Okay.
Stephanie, did you see John's question?
I just saw it right now.
Yeah.
So we have another one.
So I'm familiar with it. So
Okay.
The question is, let's say someone's living in a property, a duplex. They live in one, they rent the other. Can they still do a 1031 exchange if their primary residence is on that property?
Yes, what they'll exchange is the percentage of the property in which they rent, not them themselves live in. So it will be important, and this is where they're going to want their tax advisor's input on the percentage, because we will write the exchange documents and the exchange for the percentage of the investment side of the duplex. We've done it with large houses where someone's living in a small room and then they are renting out larger portions. We just, the easiest way to do it is by square foot. So have them work out what the square footage is for their property that, or their side that they live in, and then the square footage that is not their living quarter. And it's the percentage of their non-living quarters that will become part of the 1031 exchange sale. Does that make sense?
Yeah.
Okay. Yeah, we have that happen. We have that happen. Absolutely.
Okay, he has a follow-up question to that, which is how about property tax? And I'm sure you refer them to their CPA, but how do you know how the property tax base transfer would work?
That's going to be a question for the CPA.
Okay,
Yeah.
got it.
Yeah.
Do you have more questions? Maybe one more we can throw in.
Just kind of foreigner participate if they have.
Yeah, I think he said, yeah, we can do from one state to another. Kyle
Yeah.
has another question. Can you do an exchange and purchase a business instead of real estate?
No, has to be real estate, has to be real property. Likewise, you cannot engage with a 1031 on a mobile home. If the mobile home is including the land that the mobile home is on, then yes. But if you're only selling something that is non-real estate, non-property, then no, it cannot engage into a 1031. We had a question on that with a cell phone tower. Cell phone tower did not qualify, but the land that the tower was on did, and so he ended up selling the land as well.
Got it.
Yeah.
Awesome. You know, I did have a question, Tira, on 1031 exchanges plus ADUs. I know we had talked about this offline, but let's say you're selling your investment, you're buying another investment with an ADU that's already been built, which I'm sure we're not going to see a lot of those, but how would that work? Would it be considered just an SFR with an ADU, or how would you guys look at that investment transaction there?
So let me clarify, because we actually do have people calling about ADUs. But typically it's to build one on an already owned investment property.
Got it.
Which they can do, but that becomes a build to suit or an improvement exchange. With the 1031 exchange, think of it as an umbrella, and then there's multiple types of exchange types. There's the forward exchange, the reverse, and then there's these build to suits and improvement exchange plans. The build to suit is great for the ADUs, people who already have an investment property, or people who own their property that they live in, and now they want to build an ADU on that property. That's when you want to look at a build to suit or an improvement exchange. Our company doesn't handle them, so I don't have a lot of information on that, but I can always refer you out. But did that answer your question about the ADU?
Yes, it did. It did.
Okay.
I didn't know there was that many different types of exchanges under the 1031 exchange umbrella. I'm just very familiar with, I think, the one you went over today, which is your standard or more traditional 1031 exchange.
Yeah.
But
The forward exchange is very, very basic, inexpensive, and it is the most commonly seen exchange. The reverse exchange is more difficult. Someone who's entering a reverse where they're going to purchase first and then sell, they have to be very cash rich in order to do that.
got it. Awesome. All right. Well, thanks, guys. I think that's good enough with the Q&As. If you guys have any other questions, I will keep Tira's contact information up top while Tracy speaks. But just to give you guys a quick overview, this is what Tira went over, is qualifying for an exchange, right? What you need to, what are the requirements in order for you to be able to qualify? What is the vesting and title information going to look like? What is like kind of exchange supposed to look like, which means equal or greater value? Forward exchange timeline. So she talked about the importance of timeframes as well. So once you identify and say to yourself, okay, it sounds like I do meet this criteria and I am qualified for a 1031 exchange. Now let's move forward with the sale of my investment, right? When you decide to list your property for sale and you've now entered into contract and you have an offer accepted and now you're in escrow, you got to make sure that the escrow company that you're working with is also 1031 exchange friendly, and which is how Tira and Tracy work together hand in hand. They've done a lot of these together. So I just wanted to give Tracy, the mic for a little bit so she can share what that process looks like and how that would work, right? What does the sale process look like? What does the escrow process look like? And once we've closed escrow on your sale, what does the 1031 exchange process look like soon after? So we're gonna hand it over to Tracy and then we'll close it out at 1 o'clock. Thank you, guys. Tracy, are you there? Or did she? Let's call her. She's there, but. Tracy, maybe you're trying to unmic. You'd have to click your mic. Oh, there you go. Did you unmic? Can you hear us? I don't think I can hear her. I see that she has two, but. All right, we'll give it about a minute or two. I'm gonna call her in the meantime and see if she's having issues.
And just to let you know, I'm scanning right now the PowerPoint slide, and I'm going to email that to you. That way, everybody has the text that's written on that one particular kind page. That way, everybody has that information.
Perfect. Okay. Tracy said I can't hear, and I think she accidentally logged off, or she's having issues as well. But we'll see if we can add her for the next one, or maybe when we send out your presentation, Tira, we'll attach some information on Tracy's escrow as well. And hopefully if you guys want more details on what that process looks like, then we can help you guys throughout the entire process. Just connect with myself or Tira and the team. And I guess we can finish it off there. Does anybody have any other questions, closing thoughts, anything you guys would like to add? Nope. Okay. Awesome. Well, again, thank you, Tara. I know you're busy and I know you've got a lot, you got to get back to work. So we'll let you do that. And I want to thank everybody else for your time. Thank you guys for being here. We will see you guys next month, and we will go ahead and send over information about our next webinar. Like I said, we will be doing this every month, and we'll be sharing different investment strategies that will help you with your potential investments or current investments here at True Door Property Management. Thank you, guys.
Thank you so much.
Thank you. You guys have a good day. Bye-bye.
Bye-bye.